Have you ever dreamt of turning your spare cash into a wealth-building machine? Are you tired of watching your money slowly disappear in a savings account that barely keeps pace with inflation? Well, my friend, buckle up, because you're about to embark on a journey to financial freedom. Now, this isn't your average investing video for beginners. This is a full-fledged course and a comprehensive guide designed to equip you with the knowledge and strategies that you're going to need to become a confident investor. We're talking everything you ever wanted to know about investing, from understanding different types of stocks and choosing the right brokerage account to making your first investment with confidence and developing strategies to manage your portfolio like a pro. Yes, we got it all covered. Well, investing in the stock market may seem daunting at first, but let me tell you something. With the right knowledge and approach, it can be a rewarding journey towards financial independence. So how do we get started on this journey of becoming financially free with stocks? Well, for that we got to first understand the basics. So how about we start with what a stock actually is? What are stocks? Well, think of a stock as a tiny piece of ownership in a company. When you buy a stock, you're essentially buying a share of that company. Companies issue stocks as a way to raise money to grow their businesses. And when you own a stock, you become a shareholder of that company, which means you have a small say in how the company is run. Like imagine you own a pizza shop with your friends. To expand your business, you decide to sell 100 shares of your pizza shop to other people. Each share represents 1% ownership in the pizza shop. So if someone buys 10 shares, they're going to own 10% of your pizza shop. Those people who bought shares are shareholders, and they're going to be entitled to a portion of the profits your pizza shop makes. Now that we've discussed the general concept of what stock is, let's delve deep into various types of stocks in the stock market. Number 1. Common stocks. Common stocks simply represent ownership in a company. When you buy a common stock, you become a shareholder and have voting rights in the company's decisions. Common shareholders may receive dividends, which are a portion of the company's profits distributed to shareholders. However, dividends are not guaranteed and are typically paid out after preferred shareholders are paid. Number 2. Preferred stocks. Preferred stocks, as the name suggests, have preferences over common stocks when it comes to dividends. Preferred shareholders usually receive fixed dividend payments, and these dividends must be paid before dividends can be distributed to common shareholders. Preferred shareholders typically do not have voting rights in the company's decisions. However, they have a higher claim on the company's assets and earnings compared to common shareholders if the company goes bankrupt. Number 3. Blue chip stocks. Blue chip stocks refer to stocks of large, well-established companies with a history of stable performance. These companies are often leaders in their industries and have a track record of consistent growth and profitability. Blue chip stocks are known for paying regular dividends to shareholders, making them attractive to income-oriented investors seeking steady income streams. Number 4. Growth stocks. Growth stocks are from companies that are expected to grow at a faster rate than other companies in the market. These companies typically reinvest most of their profits back into the business to fuel growth rather than paying dividends. Investors buy growth stocks with the expectation that their share prices will increase significantly over time as the company expands its market share, introduces new products, or enters new markets. Number 5. Value stocks. Value stocks are stocks of companies that are considered undervalued by the market. These companies may have strong fundamentals, such as low price-to-earnings ratios or high dividend yields, but their stock prices haven't caught up to their true value yet. Investors buy value stocks with the expectation that the market will eventually recognize their true worth, leading to an increase in share prices. Number 6. Penny stocks. Penny stocks are stocks that trade at very low prices, typically below $5 per share. They are often issued by small, speculative companies with limited financial information available to investors. Penny stocks are considered highly speculative and can be very volatile. While they offer the potential for high returns, they also carry a high level of risk, including the risk of losing your entire investment. Now, understanding the different types of stocks is essential for beginners entering the stock market. By knowing the characteristics and risk profiles of each type of stock, you're going to be able to make informed decisions that align with your investment goals and risk tolerance. Remember to conduct thorough research and consider seeking advice from financial professionals before investing in any type of stock. Now that you know how many different types of stocks there are, let's take a look at how stocks are traded. Did you know that every single day, billions of dollars worth of stocks are bought and sold around the world? That's right, we're talking about a global game of financial frenzy that never seems to sleep. But how exactly does all this trading magic happen? Stick around, because we're about to find out. First, let's talk about stock exchanges. Stocks are primarily traded on stock exchanges, which are platforms where buyers and sellers come together to trade them. Some of the most famous stock exchanges are like household names in the world of finance. The New York Stock Exchange, often referred to as Wall Street, is a titan in the industry, known for its iconic trading floor and home to some of the world's most recognizable companies like Apple and Microsoft. Then there's the Nasdaq, another powerhouse exchange based in New York, but with a focus on technology giants like Google and Amazon. But the world of stock exchanges extends far beyond the US. Across the pond, the London Stock Exchange LSE is a major player, boasting historic roots and hosting companies like Unilever and HSBC. Europe also has the Pan-European exchange Euronext, which combines the power of several national exchanges, creating a significant marketplace. If you look at Asia, the Tokyo Stock Exchange TSE is a dominant force, representing the economic might of Japan, while the Shanghai Stock Exchange and the Hong Kong Stock Exchange are key players in China's booming markets. These are just a few examples. There are numerous other stock exchanges around the world, each catering to specific regions and industries. From the Toronto Stock Exchange TSX in Canada to the Australian Securities Exchange ASX, the global network of exchanges keeps the engine of investment humming. Now that you know about all these stock exchanges, let's get down to the nitty-gritty. It's time to understand how the buying and selling of stocks actually happens. Enter the realm of brokerage accounts. Think of them as your personal gateway to the stock market. It's where you'll deposit your investment funds, kind of like a special bank account for buying and selling those tiny pieces of ownership we call stocks. There are different types of brokerage accounts available, each with its own features and fees, but they all essentially serve the same purpose, which is connecting you to the stock exchanges. Now, you might be wondering, how do I choose the right brokerage account? Well, don't worry. We'll take care of that in the later part of the video. For now, let's shift gears and focus on how you can actually execute your investment decisions. How do you tell the market you want to buy a specific company's stock, or sell some shares you already own? The answer lies in buying and selling orders, which brings us to our next section: types of orders. The stock market isn't a one-size-fits-all kind of place. When it comes to buying and selling shares, you have a variety of orders at your disposal, each with its own advantages and quirks. Here's a breakdown of some common order types. First, basic orders. Picture yourself in the exciting world of the stock market. It's like a bustling city full of opportunities, but you need the right tools to navigate it. Let me introduce you to some basic orders that are like your trusty sidekicks in this adventure. Number 1. Market order. A market order instructs your broker to execute a trade immediately at the best available price in the market at that moment. These orders guarantee execution, ensuring your buy or sell order is filled quickly. They are straightforward and require no additional price specifications. However, you may not get the exact price you were hoping for, particularly in volatile markets where prices fluctuate rapidly. And large market orders can potentially influence the market price, especially for thinly traded stocks. Number 2. Limit order. A limit order specifies a predetermined price limit at which you are willing to buy or sell a security. These orders offer greater control over the execution price, ensuring your trade aligns with your desired price point. They can be used strategically to limit potential losses, especially with sell orders that establish a minimum acceptable price. However, there is no guarantee a limit order will be filled, especially if the market price doesn't reach your specified limit. And limit orders may take longer to execute compared to market orders, as they rely on the market price reaching your desired level. Now let's talk about advanced orders. Beyond the foundational market and limit orders, the world of stock market transactions offers more sophisticated tools for managing risk and seizing opportunities. Here's a breakdown of 3 prominent advanced order types. Number 1. Stop order. A stop order is a conditional order that gets triggered only if the underlying security's price reaches a specific point, known as the stop price. There are 2 types of stop orders: stop loss order and stop buy order. Stop loss order is triggered if the price falls below the stop price. aiming to limit potential losses on a long position where you own shares. Whereas stop buy order is triggered if the price rises above the stop price, designed to capitalize on a potential breakout or uptrend. Number 2. Stop limit order. A stop limit order combines the features of a stop order and a limit order. It gets triggered only if the stop price is reached, but the actual trade is executed only at the specified limit price or better. Compared to stop orders, stop limit orders offer more control over the execution price, mitigating the risk of unfavorable fills. Stop limit orders may not be filled at all if the market price moves rapidly past the stop price without reaching the limit price. Setting stop limit orders requires managing both the stop price and the limit price, adding a layer of complexity. Number 3. Trailing stop order. A trailing stop order is a dynamic variation of a stop-loss order. The stop price is not a fixed value but automatically adjusts itself by a certain percentage or dollar amount below the current market price for a long position and above for a short position. Trailing stop orders continuously adjust the stop price, potentially locking in profits as the stock price rises and limiting potential losses during a downturn. Trailing stop orders might exit positions prematurely during price corrections, leading to missed gains. Understanding the types of orders is essential for executing your investment strategy, which is directly tied to your investment goals. So next up, we're going to talk about how you can set your investment goals. Before making any investment decisions, you got to define your investment goals. Are you investing for retirement, saving for a down payment on a house, or are you aiming to grow your wealth over the long term? Understanding your objectives is going to help shape your investment strategy and guide your decision-making process. Your investment goals can be categorized into 2 main time frames, short-term and long-term. Short-term investment goals are financial objectives that you aim to achieve within a relatively brief period, typically ranging from a few months to a couple of years. Whereas long-term investment goals are financial objectives that you work towards achieving over an extended period, usually spanning several years or even decades. Let's say you are saving up for a vacation, a down payment on a car, or an emergency fund to cover unexpected expenses. Such goals are deemed as short-term investment goals. They are all about meeting immediate needs and addressing near-term financial priorities. They help you manage your day-to-day finances and navigate life's short-term challenges. Whereas long-term goals often revolve around building wealth, securing financial independence, and achieving major milestones such as retirement, buying a home, funding your children's education, or leaving a legacy for future generations. They require patience, discipline, and a big-picture perspective. Also, they involve planning for the distant future and making strategic decisions to ensure your financial security and well-being over the long haul. So to sum it all up, whether you're saving up for a dream vacation next year or planning for a comfortable retirement down the line, understanding the difference between short-term and long-term investment goals is crucial for creating a financial plan that aligns with your aspirations and priorities. By setting clear goals and choosing appropriate investment strategies, you can chart a course towards a brighter financial future, one milestone at a time. Now, once you've nailed down your investment goals, the next crucial step towards being an intelligent investor is figuring out your risk tolerance. Ever wondered how comfortable you are with taking risks in the world of investing? Well, if you haven't given it much thought, then it's high time you did. It's a process that evaluates how okay you are with the possibility of losing money in exchange for the potential of making more. Risk tolerance is the degree of risk that an investor is willing to endure given the volatility in the value of an investment. An important component in investing, risk tolerance often determines the type and amount of investments that an individual chooses. Greater risk tolerance is often synonymous with investment in stocks, equity funds, and exchange-traded funds ETFs, while lower risk tolerance is often associated with the purchase of bonds, bond funds, and income funds. All investments involve some degree of risk, and knowing their risk tolerance level helps investors plan their entire portfolio, determining how they invest. Based on how much risk they can tolerate, investors are classified as aggressive, moderate, and conservative. Number 1. Aggressive risk tolerance. Aggressive investors tend to be market savvy with an understanding of the volatility of securities and follow strategies for achieving higher than average returns. Their investments emphasize capital appreciation rather than income or preserving their principal investment. This investor's asset allocation commonly includes stocks and little or no allocation to bonds or cash. Number 2. Moderate risk tolerance. Moderate investors want to grow their money without losing too much. Their goal is to weigh opportunities and risks, and this investor's approach is sometimes described as a balanced strategy. Usually, moderate investors develop a portfolio that includes a mixture of stocks and bonds, perhaps as a 50-50 or 60-40 structure. Number 3. Conservative risk tolerance. Conservative investors are willing to accept little to no volatility in their investment portfolios. Retirees or those close to retirement age are often included in this category, as they may be unwilling to risk a loss to their principal investment and have a short-term investment strategy. Now, it's time to explore the investment principles that will serve as your compass and guide you along the way. Have you ever wondered why principles matter in investing? Investment principles are fundamental guidelines that inform the decision-making process in managing investment portfolios. These principles are rooted in financial theory and empirical evidence, guiding investors in maximizing returns while managing risk. By understanding and applying these principles, you can increase your chances of achieving your financial goals over the long term. Now, here are some core principles to consider. First, we have diversification. Diversification is the process of spreading investments across different asset classes, industries, and geographic regions to reduce the overall risk of an investment portfolio. The idea is that by holding a variety of investments, the poor performance of any one investment potentially can be offset by the better performance of another, leading to a more consistent overall return. Diversification thus aims to include assets that are not highly correlated with one another. It helps to mitigate unsystematic risk, while systematic or market risk is generally unavoidable. A diversified portfolio may lead to better opportunities, enjoyment in researching new assets, and higher risk-adjusted returns. The strategy of diversification is actively promoted by the U.S. Securities and Exchange Commission. Diversification attempts to protect against losses. This is especially important for older investors who need to preserve wealth toward the end of their professional careers. It is also important for retirees or individuals approaching retirement that may no longer have stable income. If you are relying on their portfolio to cover living expenses, it is crucial to consider risk over returns. Second, we have risk management. Risk management is the process of identification, analysis, and acceptance or mitigation of uncertainty in investment decisions. It involves identifying, analyzing, and accepting or mitigating uncertainty in investment decisions. It occurs everywhere in the realm of finance. For instance, 1. An investor may choose treasury bonds over corporate bonds. 2. A money manager uses strategies like portfolio diversification, asset allocation, and position sizing to mitigate or effectively manage risk. Risk is inseparable from return in the investment world. One of the tactics to ascertain risk is standard deviation, which is a statistical measure of dispersion around a central tendency. Diligent risk management can help reduce the chance of losses while ensuring that financial goals are met. Risk management essentially occurs when an investor or fund manager analyzes and attempts to quantify the potential for losses in an investment, such as moral hazard, and then takes the appropriate action to meet their objectives and risk tolerance. And third, we have importance of research and due diligence. Due diligence is an investigation, audit, or review performed to confirm facts or details of a matter under consideration. It is a systematic way to analyze and mitigate risk from a business or investment decision. It involves examining a company's numbers, comparing the numbers over time, and benchmarking them against competitors. Due diligence became common practice and a common term in the United States with the passage of the Securities Act 1933. With that law, securities dealers and brokers became responsible for fully disclosing material information about the instruments they were selling. Failing to disclose this information to potential investors made dealers and brokers liable for criminal prosecution. It is performed by equity research analysts, fund managers, broker-dealers, individual investors, and companies that are considering acquiring other companies. Due diligence by individual investors is voluntary. However, broker-dealers are legally obligated to conduct due diligence on a security before selling it. Now that we're familiar with the basic investment principles, let's talk about how to select the right kind of stock. Well, stock selection is the process of choosing individual stocks to invest in within the stock market. It involves researching and analyzing various companies to identify those that offer the best potential for returns based on an investor's goals, risk tolerance, and investment strategy. Let's understand some key aspects that you must consider when selecting stocks. First, let's talk about fundamental analysis. Think of fundamental analysis as getting to know a company before investing in it. This includes things like how much money the company is making, how much it owes, and what it owns. Then, you step back and look at the bigger picture. You consider what's happening in the economy and the industry that the company is a part of. Are there any trends or events that could affect its future success? After gathering all this information, you weigh the pros and cons to decide if the company is worth investing in. If everything checks out and looks promising, you might decide to invest. But if there are any warning signs or uncertainties, you might hold off. All right, let's break down fundamental analysis and delve into its key components. Think of it as peeling back the layers of an onion to uncover its essence. Here we're going to touch on 3 crucial factors. Number 1. Earnings. Earnings refer to a company's profits in a given quarter or fiscal year. After the end of each quarter, analysts wait for the earnings of the companies they follow to be released. Earnings are studied because they represent a direct link to company performance. They are a key figure used to determine a stock's value, especially if they are different than what analysts predicted. As a result, the numbers are subject to potential manipulation. A company's earnings are used in many common ratios for financial analysis, such as earnings per share and earnings yield. Financial ratios using earnings can be used to determine the health and stability of a company, as well as whether its stock is over or undervalued. There are many measures and uses of earnings. Some analysts like to calculate earnings before tax (EBT), also known as pre-tax income. Some analysts prefer to see earnings before interest and taxes (EBIT). Still, other analysts, mainly in industries with a high level of fixed assets, prefer to see earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. Number 2. Revenue growth. Revenue growth refers to the increase in a company's total revenue or income over a specific period, typically calculated quarterly or annually, but you can also calculate monthly or weekly revenue growth. It's a key metric used to assess a company's financial health and its potential for future success. Now let's see how we can calculate revenue growth. Imagine a company makes $1 million in revenue this year. Last year they made $800,000. To calculate their revenue growth, we subtract the previous year's revenue from the current year's revenue and then divide by the previous year's revenue. In this example, the company's revenue grew by 25% year over year. A high revenue growth rate indicates that a company's sales are increasing, which is generally a positive sign. However, it's important to consider other factors alongside revenue growth. For instance, a company might achieve high revenue growth by offering deep discounts, which could hurt their profit margins in the long run. Number 3. Price-to-earnings ratio, also known as PE ratio. The price-to-earnings or PE ratio is the proportion of a company's share price to its earnings per share. A high PE ratio could mean that a company's stock is overvalued or that investors expect high growth rates. It's handy for comparing a company's valuation against its historical performance, against other firms within its industry, or the overall market. Companies with no earnings or companies that are losing money don't have a PE ratio because there's nothing to put in the denominator. The 2 most used PE ratios are forward price to earnings and trailing price to earnings. First, let's talk about forward price to earnings. The forward PE uses future earnings guidance rather than trailing figures. This forward-looking indicator helps compare current earnings to future earnings and can clarify what earnings will look like without changes and other accounting adjustments. Now let's talk about trailing price to earnings. The trailing PE relies on past performance by dividing the current share price by the total earning per share for the previous 12 months. It's the most popular PE metric because it's thought to be objective, assuming the company reported earnings accurately. But the trailing PE also has its share of shortcomings, including that a company's past performance doesn't necessarily determine future earnings. Now that we've talked about fundamental analysis, let's move on to technical analysis. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Unlike fundamental analysis, which attempts to evaluate a security's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. Technical analysis as we know it today was first introduced by Charles Dow and the Dow theory in the late 1800s. Technical analysis tools are used to scrutinize the way supply and demand for a security will affect changes in price, volume, and implied volatility. Here are some of the key components of technical analysis. Number 1. Chart patterns. Chart patterns are the foundational building blocks of technical analysis. They repeat themselves in the market time and time again and are relatively easy to spot. The measurements of the chart pattern can be used to project the next price movement and what target to aim for. These patterns can either be traded aggressively or conservatively, so the rules of entry and exit can vary. It's easy to calculate the reward risk for them, which is important to know before entering a trade. Number 2. Moving averages. A moving average is a technical indicator that market analysts and investors may use to determine the direction of a trend. It sums up the data points of a financial security over a specific time period and divides the total by the number of data points to arrive at an average. It is called a moving average because it is continually recalculated based on the latest price data. Analysts use the moving average to examine support and resistance by evaluating the movements of an asset's price. A moving average reflects the previous price action movement of a security. Analysts or investors then use the information to determine the potential direction of the asset price. It is known as a lagging indicator because it trails the price action of the underlying asset to produce a signal or show the direction of a given trend. Number 3. Oscillator. An oscillator is a technical analysis tool that constructs high and low bands between two extreme values and then builds a trend indicator that fluctuates within these bounds. In technical analysis, investors find oscillators to be one of the most important technical tools to understand. If an investor uses an oscillator, they first pick two values, then, placing the tool between the two, the oscillator oscillates, creating a trend indicator. In technical analysis, an investor measures oscillators on a percentage scale from 0 to 100, where the closing price is relative to the total price range for a specified number of bars in a given bar chart. When the market trades in a specific range, the oscillator follows the price fluctuations and indicates an overbought condition when it exceeds 70 to 80% of the specified total price range, signifying a selling opportunity. An oversold condition exists when the oscillator falls below 30 to 20%, which signifies a buying opportunity. Now that you know how to conduct fundamental and technical analysis, let's get started with investing. Well, investing can be a powerful tool, but it's important to have the right foundation. Choosing a brokerage platform is one of the crucial steps. It's your gateway to the investment world, and just like any important journey, you want to start with the right gear. So let's talk about choosing a brokerage platform first. Think of a brokerage platform as your investment partner. It's the platform you'll use to buy and sell investments like stocks, bonds, and ETFs, exchange-traded funds. Choosing the right one is like picking the perfect travel companion for your financial journey. You want someone reliable, easy to work with, and who aligns with your goals and preferences. Here's a breakdown of the two main types of brokerage platforms. Number 1. Online brokers. The self-directed explorer. Are you a born adventurer who thrives on taking charge? Then an online broker might be your perfect match. Think of it as a vast online marketplace overflowing with investment options. Stocks, bonds, ETFs, and more. You'll have the freedom to explore different investment strategies, research companies you believe in, and make your own buying and selling decisions. Here are a few examples. First up, we have TD Ameritrade. Known for its robust trading platform Thinkorswim, TD Ameritrade offers a plethora of investment options including stocks, ETFs, mutual funds, options, and more. It provides advanced trading tools for active traders as well as educational resources for beginners. Second, we have E-Trade. E-Trade is another popular online broker offering a variety of investment products and tools. It provides access to stocks, bonds, options, mutual funds, and ETFs. E-Trade's Power E-Trade platform is renowned for its user-friendly interface and research tools. Third, we have Charles Schwab. With a strong reputation in the industry, Charles Schwab offers a comprehensive suite of investment options and resources. Investors can trade stocks, ETFs, mutual funds, options, and more. Schwab's Street Smart Edge platform provides powerful trading tools and real-time market data. Number 2. Robo-Advisors. The automated ally. Perhaps you're more of a set-it-and-forget-it kind of adventurer. If the idea of constant research and decision-making feels overwhelming, then a robo-advisor might be your perfect partner. Think of it as a friendly, automated investment robot. You simply answer some questions about your goals and risk tolerance, and the robo-advisor builds and manages a personalized investment portfolio for you. Here are some examples. First, we have Wealthfront. Wealthfront is a leading robo-advisor known for its automated investment management services. It creates and manages diversified portfolios of low-cost ETFs based on each client's risk tolerance and financial goals. Wealthfront also offers features like tax loss harvesting and direct indexing. Second, we have Betterment. Betterment is a popular robo-advisor that offers personalized investment portfolios tailored to individual goals and risk preferences. It utilizes modern portfolio theory to optimize asset allocation and minimize fees. Betterment's platform also includes tools for retirement planning and goal tracking. Third, we have Robo-Global. Robo-Global specializes in thematic investing, focusing on disruptive technologies and trends. It offers a range of thematic portfolios centered around themes like robotics, artificial intelligence, and healthcare innovation. Robo-Global's portfolios are managed by industry experts and powered by proprietary research. Now that you know about online brokers and robo-advisors, let's get you prepped for the next step, which is opening an account. Think of opening an account as setting up your base camp for your investment adventure. Once you've chosen your platform, the process is usually quite straightforward. You'll typically need to provide some basic information, like your social security number and proof of address. Now that you've established your base camp with your chosen platform, it's time to explore the different types of investment accounts available. Think of these accounts as specialized backpacks for your investment journey, each designed for a specific purpose. Number 1. Individual brokerage accounts. Imagine an individual brokerage account as your personal investment backpack. It's the most common type of account, offering you a lot of flexibility and control over your investments. You can contribute your own money after taxes and invest in a wide variety of assets, like stocks, bonds, ETFs, and more. Number 2. Retirement accounts. Now let's talk about special accounts designed to treasure your future self-retirement accounts. Imagine them as treasure chests where you can stash away money for your golden years. These accounts come with awesome tax benefits to reward you for being so smart and saving early. There are two main types of retirement accounts. Number 1. Individual retirement accounts, also known as IRAs. These are like solo treasure chests you set up yourself, separate from your employer. There are different types of IRAs, each with its own limits on how much you can contribute and how the taxes work. Number 2. 401ks. These are retirement plans offered by your employer. The best part? Some employers might even match a portion of your contributions, basically giving you free money for retirement. Now I know you're pumped about starting your investment journey. That's fantastic. We've talked about finding your brokerage platform and setting up your account. Now, let's talk about something not as exciting but super important. Yup, that's fees and commissions. All right, imagine fees and commissions as the hidden costs of your investment journey. They're like those pesky little charges that can sneak up on you and eat into your profits, but fear not. By understanding these fees, you can navigate the investment landscape like a pro and ensure that your hard-earned money is working for you, not against you. So before you jump into any investment opportunity, take a peek at those fees and commissions and make sure they're in line with your financial goals. After all, it's your money, so let's make sure it's working smartly for you. All right, now that you've got a handle on understanding fees and commissions, let's dive into the exciting world of making your first stock investment. Get ready to take the plunge into the stock market and embark on an adventure that could potentially grow your wealth and secure your financial future. So buckle up and get ready to learn the ins and outs of making your first stock investment. It's going to be a thrilling ride. Here's a breakdown of the steps involved in making your first stock investment. Let's first start with setting a budget. Think of this as laying the groundwork for your investment journey. Determine how much money you're comfortable investing. It's like setting your spending limit before going shopping. Consider your financial goals, risk tolerance, and available funds to come up with a budget that works for you. The second step is researching and selecting stocks. This step is like doing your homework before making a big purchase. Research different companies and industries to find ones that align with your investment goals and values. Look at factors like financial health, growth potential, and industry trends to narrow down your options and select stocks that you believe have strong prospects for the future. Now, the third step is placing an order. Once you've chosen the stocks you want to invest in, it's time to place your order. This is like pulling the trigger on your purchase. Whether you're using an online brokerage platform or working with a financial advisor, follow the steps to place your order and become a proud owner of your chosen stocks. All right, now the final step is monitoring your investment. Congratulations, you're now a stock investor, but the journey doesn't end here. Now it's time to keep an eye on your investment. This step is like tending to a garden after planting seeds. So you got to first monitor the performance of your stocks, and then stay informed about market trends and company news, and be prepared to make adjustments to your portfolio as needed to stay on track towards your financial goals. By following these steps, you'll be well equipped to embark on your first stock investment journey with confidence and clarity. Now let's talk about managing and reviewing your portfolio. Congratulations, you've made your first investment and are officially on your investment adventure. But just like any journey, it's important to keep an eye on things to make sure you stay on track. This is where managing and reviewing your portfolio come in. Think of your portfolio as your investment backpack. Inside, you have all your different investments: stocks, bonds, ETFs, and maybe even some cash. Managing your portfolio involves three things. The first one is regular portfolio assessment. Well, regular portfolio assessment is the practice of periodically reviewing and evaluating the performance and composition of an investment portfolio. It involves analyzing various aspects of the portfolio to ensure it remains aligned with the investor's financial goals, risk tolerance, and investment strategy. Assessing the performance of the portfolio involves comparing its returns against relevant benchmarks or targets over a specific time period. It includes reviewing the current asset allocation to ensure it remains consistent with the investor's desired risk-return profile. By conducting regular portfolio assessments, investors can monitor the performance and health of their investments, identify opportunities for improvement, and make informed decisions to optimize their portfolio's risk-return profile over time. Now, the second thing you got to be careful of while managing and reviewing your portfolio is rebalancing your holdings. Rebalancing your holdings refers to the process of adjusting the composition of your investment portfolio to bring it back in line with your target asset allocation. Over time, the performance of different investments within your portfolio may cause their proportions to deviate from your original plan. Rebalancing involves selling assets that have become overweighted and buying assets that have become underweighted to restore the desired balance. Rebalancing your holdings is an essential part of portfolio management, helping to control risk, maintain diversification, and stay aligned with your long-term investment objectives. By periodically rebalancing your portfolio, you can keep it on track to meet your financial goals while navigating changing market conditions. And finally, the third thing you got to be careful of while managing and reviewing your portfolio is staying informed about market trends. Staying informed about market trends is essential for investors to navigate the dynamic landscape of finance effectively. It involves actively monitoring various factors that influence financial markets, such as economic indicators, corporate earnings reports, and geopolitical events. By keeping abreast of financial news through diverse sources like newspapers, websites, and television channels, investors gain insights into market developments and emerging opportunities. Leading newspapers such as the Wall Street Journal, Financial Times, and The Economist are revered for their comprehensive coverage of financial news and analysis. Meanwhile, prominent websites like Bloomberg, CNBC, and Reuters offer real-time market data, breaking news, and expert commentary accessible to a global audience. For those preferring television coverage, channels such as CNBC, Bloomberg Television, and BBC World News provide 24-hour programming dedicated to business news, market updates, and insightful interviews with industry experts. Now, monitoring economic indicators such as GDP growth, unemployment rates, and inflation data provides valuable insights into the overall health of the economy and potential market trends. Moreover, staying connected with market commentary from analysts and experts helps investors interpret market dynamics and adjust their investment strategies accordingly. By staying informed about market trends through these channels, investors can adapt to changing market conditions, capitalize on opportunities, and mitigate risks effectively in pursuit of their financial goals. You don't have to become a market expert overnight. Even staying up to date on major news and trends can significantly enhance your investment journey. We've covered the essential tools for managing your portfolio: regular assessment, rebalancing, and staying informed. Now, let's explore some powerful strategies that can set you on the path to long-term investment success. Think of your investment journey like building a sturdy tree for your future. The following strategies will help you nurture your investment tree and watch it grow strong over time. First, we have dollar cost averaging, or DCA. Dollar cost averaging is the practice of investing a consistent dollar amount in the same investment at regular intervals. Investors looking to reduce investment risk frequently consider this strategy. While this approach might help you better manage risk, you are less likely to have outsized returns. There are pros and cons to dollar cost averaging that can help investors determine if it is the right investment strategy for them. Dollar cost averaging is pretty simple. Pick a stock, fund, or other asset, then decide on a fixed amount to invest in it regularly. With dollar cost averaging, you invest a set amount in the same asset at regular intervals, such as once a month or every payday. It doesn't matter what the price of the investment is. You keep adding to your holding whether its valuation is up or down. Second, we have Dividend Reinvestment Plan, or DRIPs. A dividend reinvestment plan, or DRIP, is a program that allows investors to reinvest their cash dividends into additional shares or fractional shares of the underlying stock on the dividend payment date. Although the term can apply to any automatic reinvestment arrangement set up through a brokerage or investment company, it generally refers to a formal program offered by a publicly traded corporation to existing shareholders. Around 650 companies and 500 closed-end funds currently do so. Normally, when dividends are paid, they are received by shareholders as a check or a direct deposit into their bank account. DRIPs, which are also known as dividend reinvestment programs, give shareholders the option of reinvesting the amount of a declared dividend into additional shares, which are bought directly from the company. Because shares purchased through a DRIP typically come from the company's own reserve, they are not marketable through stock exchanges. And third, we have investing in index funds and ETFs. Index funds are funds that represent a theoretical segment of the market. They're designed to act as the performance and makeup of a financial market index. You can't invest in an index itself, but you can invest in an index fund. You're utilizing a form of passive investing that sets rules by which stocks are included and then tracks the stocks without trying to beat them. Whereas ETFs are baskets of assets that are traded like securities. They can be bought and sold on an open exchange just like regular stocks. Mutual funds are only priced at the end of the day. The main difference between an ETF and an index fund is that ETFs can be traded during the day and index funds can only be traded at the set price point at the end of the trading day. Well, consistency is key. By incorporating these strategies into your investment plan and staying disciplined over the long term, you can significantly increase your chances of achieving your financial goals and watching your investment tree flourish. We've explored powerful strategies like dollar cost averaging and index funds that act like fertilizer for your long-term investment success. But even the most carefully nurtured tree needs protection from storms. Similarly, a solid understanding of risk management can help you weather the inevitable ups and downs of the market and avoid common pitfalls that can stunt your investment growth. Now let's talk about risk management and avoiding pitfalls. First, let's talk about understanding market volatility. The investment world isn't always sunshine and smooth sailing. There will be times of market volatility, meaning prices can fluctuate rapidly. Think of them like strong winds that might shake your investment tree. While a little wind can be invigorating, strong gusts can be damaging. Understanding market volatility is crucial. By having realistic expectations and a long-term perspective, you can avoid making impulsive decisions based on short-term market fluctuations. Now, let's talk about avoiding emotional decision-making. Imagine strong emotions like fear or excitement as powerful gusts of wind threatening to topple your investment tree. Emotional decision-making can be detrimental to your investment success. Here are some tips to stay objective. Well, first, you got to stick to your investment plan. Having a well-defined plan based on your goals and risk tolerance helps you stay on track and avoid impulsive decisions based on emotions. The second thing you got to do is focus on the long term. Don't get caught up in short-term market fluctuations. Remember, you're building for the future. And lastly, you got to do your own research. Educate yourself on your investments and avoid making decisions based on hype or fear. Now, let's talk about the importance of patience and discipline. Building a strong and healthy investment tree takes time and dedication. Patience and discipline are critical for long-term success. Be patient. Don't expect to get rich overnight. Investing is a marathon, not a sprint. Stay disciplined. Stick to your investment plan and avoid making impulsive changes based on market noise. And revisit and refine. You got to regularly assess your portfolio and adjust your strategy as needed over time. In conclusion, investing in stocks can be a fulfilling endeavor that offers the potential for significant wealth accumulation over time, but it's essential to approach it with caution and do your research. By understanding the basics, setting clear investment goals, conducting thorough research, and staying disciplined in your approach, you can navigate the stock market with confidence and work towards achieving your financial objectives. Remember, investing is a journey, so stay patient, stay informed, and enjoy the process of building your financial future. All right, investors, let's wrap things up with a quick recap and a healthy dose of encouragement. So, what have we learned today? We've covered the basics of investing in stocks, from understanding what stocks are to exploring different investment strategies like dollar-cost averaging and ETFs. We've talked about the importance of risk management, avoiding common pitfalls, and staying disciplined in the face of market volatility. Remember, investing is a journey, not a sprint, and every step you take today sets you up for success tomorrow. Now, here's the fun part. The journey is just beginning. There's a whole world of knowledge out there waiting for you to explore. You keep reading, keep learning, and keep growing as an investor. Whether it's devouring investing books, joining online communities, or attending seminars, never stop seeking out new opportunities to expand your horizons and deepen your understanding of the stock market. And finally, I want to leave you with a sense of empowerment. You've taken the first step on your investing journey, and that's something to be proud of. You have the knowledge, the tools, and the confidence to start investing wisely and building wealth through the stock market. So go ahead, take that leap of faith, and watch as your financial future unfolds before your eyes. You've got this. Keep those eyeballs glued to the screen and keep soaking up all the juicy info we've got in store for you. There's always more to learn and explore in the exciting world of investing. So don't click away. We've got plenty more wisdom and insights coming your way. Stick around and keep watching. The journey is just beginning. There's a whole world of knowledge out there waiting for you to explore. Never stop seeking out new opportunities to expand your horizons and deepen your understanding of the stock market. And with that, I'll leave you to embark on your investing adventure. Remember, the stock market is full of ups and downs, but with patience, discipline, and a little bit of know-how, you'll be well on your way to financial success. So, happy investing! Thanks for watching the video till the end. Please give it a thumbs up if you enjoyed it and let us know in the comments what you found most informative. Subscribe to our channel for more in-depth investment videos like this. Catch you in the next one.